is here on CNBC-TV18. Shibani Sircar Kurian is Senior EVP and Head of Equity Research at Kotak Mahindra Asset Management Company. Shibani, good to have you with us here. Thank you for your time. You know, on a day like today, if you speak with a mutual fund manager, it's not a question. The first question will not be about the market. I hope you understand. It's about the circular. Another circular, actually. It's the email, is the directive from SEBI to AMFI and then AMFI to mutual funds about you know what they say, right? The line starts by saying, in the context of the euphoria building up in the mid and small cap space, and then it goes on. So I'm sure there is intense discussion going on and how to kind of comply and meet what SEBI wants you to do. Just give us a flavor of the kind of discussions you've been having internally.
Hi, Prashant. Good afternoon. So if you look at, what we have been also noticing and commenting on various forums for a while is that while, from a market perspective, clearly mid and small caps have seen significant improvement on earnings trajectory, and they have also been outperforming large caps in terms of earnings, and that has reflected in terms of the re-rating on the valuation front. In terms of their historic average multiples and current multiples, there is a vast deviation, especially where some of the small cap names are concerned. And we have been citing caution in terms of our commentary, given the kind of valuation re-rating and also with respect to large caps, where mid and small cap valuations have been. And that is a reflection of what we have also been stating at our end, especially with respect to some of the measures that we have taken at our fund house in the recent past. We continue to believe that, and of course, this is something that we will keep monitoring over a period of time, and if it's not static, but we continue to believe that while there is ample opportunity in mid and small caps over the medium to long run, in the near term, clearly valuations, especially where some of the small caps are concerned, have moved up considerably, and therefore there is need to exercise some degree of caution. And hence, this is the kind of discussions that we have had internally as well. And some of the steps that we have taken at our end reflects our view. From a fund house, we have been maintaining that if you look at market valuations where large caps are concerned are considerably more favorable. Risk reward at this point in time is in favor of large caps, and therefore tilt of portfolio should move slightly more towards large caps vis-a-vis mid and small caps. And that is something that we continue to maintain.
Okay, all right. Shibani, let's just hold on to that thought. We're having a bit of a 3 p.m. move that's taking place. So I think we should just pull up the intraday chart of the Nifty and the Nifty Bank. Both of them should come up for you on the screen. The Nifty Bank is the one actually that I want. Pull up the Nifty Bank and pull up the 20 DMA. In this last 15 minutes or so, there appears there's an expiry-related move that's taken place. That's a big recovery on the Nifty Bank. From the day's low, I think that index has gained closer around 700 points right away. Look at that beautiful looking screen over there. Now, the Nifty Bank, that's the one that's driving the markets up. So we should pull up the Nifty Bank as well as the 20 DMA. And you'll see that now it's around 150 points higher than that 20 DMA. That chart comes up for you on the screen. That's the one that I'm talking about. It's just crossed the 20 DMA. So it seems some fun and games taking place. You expect volatility to pick up, but looks like the bulls couldn't wait for 3 p.m. Just around 10 minutes before that itself, we're seeing a bit of an uptake. Well, Shibani, noted your view. You all have aligned yourself. I think the fear is that this could be disruptive in nature. If in case the regulator goes ahead and says, you sort out things, puts in a couple of caps, what is your view on it? And that's the reason why the market is a little bit nervous just for the last couple of sessions.
So, Nigel, very difficult to say what the regulator wants beyond a point in time. So going by what has come through in terms of, the circulars, etc., that you were referring to, clearly it is aimed at, ensuring that market participants understand where valuations lie, where mid and small caps are concerned. And that is what, in fact, we have also been, educating and been talking about on various forums as well. That does not, however, mean that mid and small cap as a basket in terms of investments over the medium term is something that should be avoided completely. We do believe that if you look at the earnings trajectory as well as growth opportunity where India is concerned, a lot of sectors which represent growth in India across various segments and buckets are best represented in mid and small caps. So I think we should look at it from that perspective. It is more valuations rather than just mid and small caps. Also, what we have noticed in the past, obviously markets have done well with mid and small caps outperforming. Within the mid and small cap bucket, one is valuations. Also, there have been parts of the segment where there has been some degree of froth that has built up, where one should again exercise caution. This could be stocks where overall float has been low, and therefore, you've seen very sharp up move, which have not been backed by fundamentals. And if there is a situation where stocks have moved up primarily because of low float available, not backed by fundamentals, that is also the segment where one should exercise caution. But over the medium to long term, clearly, if you believe that growth has to come through from an economic perspective, which we do believe in, there are opportunities in mid and small caps. But in the near term, valuations merit a caution, and that is something that we have been articulating as well.
All right. How are you feeling in general about the market, Shibani? Because now the mid and small caps, as you said, right, there is some amount of caution definitely because the valuations are looking uncomfortable. Would you stay away? Would you be cautious there? And I mean, even for large caps, do you think the time has come to sort of move to cash, at least part of your positions, or would you continue to buy the dip?
Sonia, so from a fund house perspective, we have avoided taking any significant cash calls, and that's been our stated philosophy, where cash has typically been in the range of 3 to 5% across our portfolios, and therefore that is something that we continue to maintain. Overall, what we believe is if you look at markets from three perspectives, one, from a macro, India continues to do well. Earnings in the recently concluded earnings season also has held up fairly well. There have been no earnings downgrades, and expectations for FY 25-26 as well as for 24 have remained largely stable. Third aspect is from a flow. Of course, we'll have to monitor how flows pan out. FII flows have been volatile, while domestic flows have been holding up. So our belief is that our view on markets continue to remain fairly positive. However, given the run-up that we have seen, specifically mid and small caps, we can't rule out volatility. We'll have to brace ourselves for some degree of near-term volatility. There are many events that will also have an impact on markets, going into elections, the possible change in terms of interest rate, as well as global events that we will have to watch out for. So our belief is that while we continue to remain fairly positive in the medium term, near-term volatility is something that we will have to contend with, and therefore, we would possibly look at entry opportunities if there is some degree of volatility.
Okay, Shibani, how you're placed on this, private versus public sector theme? Public sector is where the money is. And today my colleague as well, Hormuz, has been covering a lot of the stocks have come off the top. But if I look at the cumulative market capitalization change for today versus yesterday, actually we're 12,000 crores higher. Between today and yesterday. Obviously, the float is limited and the larger cap names are doing better, so they're making up for the ones that are not doing so well. But how you are placed out there? Clearly on select themes, it seems the market has run away itself. Maybe they're talking FY 28, 29 earnings or something like that, because these stocks are pricing in the best. But there are still pockets of value. Your take?
Yes, so absolutely. I think even in this market, there are pockets of value. So firstly, to answer your question in terms of the public versus private, our take on the entire PSU pack has been that we need to evaluate businesses, sectors on their own merit, and therefore look at sectors where valuations and fundamentals make sense. In that context, we believe that at this point in time, there have been, of course, a significant run-up in most pockets. But in segments like maybe oil and gas, some of the large public sector banks, there is still some amount of value that is still there, given the kind of fundamentals that we see. Second, in terms of pockets where valuations still remain favorable in this current market environment, one large pocket is the banking space, especially some of the large banks, and within that, some of the large private sector banks. There has been a lot of fear that there will be sharp slowdown on loan growth as there is requirement to maybe moderate CD ratio, and that's something that has come through in commentary of few of the banks, which is the credit deposit ratio, and margins have been compressing from the peak. However, today, when you look at valuations of some of these private banks with respect to their own historic average multiples, valuations are lower than historic average levels, while return ratios are better. And therefore, from a valuation perspective, this is one segment where we find valuation comfort. There will be some degree of impact because of margin pressure continuing maybe over the next 1 or 2 quarters. And loan growth is something that we will watch out for. But if you ask me in the market today, where a segment where there is valuation comfort, I would clearly say that this is one pocket which we think that from a return ratio and valuation perspective looks fairly well placed.
Okay, Shibani, we'll leave it at that. Thanks a lot for joining in and appreciate your time.